Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be doing a brief stock analysis on a McDonald's stock, ticker symbol MCD. So I actually do not own this stock, and the reason for that is basically we've gone through all the stocks and done analyses on those that I own in my dividend portfolio. So we're going to start exploring some other companies that I would be interested in owning, and I think are great companies that everyone should probably at least look at a little bit to consider, because they could probably provide some good returns depending on how you invest in them. So these companies are just companies that my brother owns in his dividend portfolio and I do not. So there's a few of those, and we're going to do stock analyses on those companies. And then after that, we'll explore some other companies that neither of us own that I'm, potentially looking to buy, or just looking to explore a little bit more and get more knowledgeable about. So first of all, we're going to take a look at their most recent earnings, which are Q1 2021 earnings, which were released at the end of April. As you can see here, their Q2 earnings should be coming out, around the end of July here in a few weeks. So that'll be exciting to see how they're doing. But for the first quarter, here's their results. They said they had 2021 global comparable sales and revenues from the quarter surpassed the first quarter of 2019 levels, driven by the US. And they basically included this because they're saying, well, 2020 was, a flop, for lack of a better term, and everyone is expecting those levels to be lower. So just because you see an increase from 2020, that is not as significant, and it's a little bit more significant and better for investors to see that there's an increase from 2019, which was a completely normal year. So they say that, and they also note that global comparable sales increased 7.5% in the first quarter, with growth across all segments. And then diluted earnings per share of $2.05 increased 39%. And there were some strategic gains, I think, from some sale of McDonald's stock that they talk about later. And if you exclude those gains, then the earnings per share were $1.92, which is an increase of 31%. And going a little bit deeper, they said that these global sales increased 7.5%, which reflects a positive comparable sales across all segments. So 13.6% increase in the US, 0.6% increase in the international operated segment, and 6.4% increase in the international developmental licensed segment. Consolidated revenues also increased 9%, and if you account for constant currencies, that goes down to 5%. System-wide sales increased 12% and 8% in constant currency. And basically, if you aren't aware, basically what the constant currency number is they're saying, well, if the relative value of the US dollar hadn't changed at all, then we would have only seen a 5% increase. But since there was some inflation and other things happening with exchange rates across the world, then the consolidated revenues on paper looked like they had a 9% increase, but there was inflation and other things, so really in reality there was really only a 5% increase, because likely expenses are going to increase by that same amount that the sales increased as well, due to inflation and those type of things. And then they talk about income. Consolidated operating income increased 35%, 30% in constant currencies, and included $135 million of strategic gains, primarily related to the sale of McDonald's Japan stock. Excluding these gains, operating income increased 27%, or 22% in constant currencies. Diluted earnings per share of $2.05, which was an increase of 39%, or 35% in constant currencies, and excluding the 13 cents per share of strategic gains, diluted earnings per share was $1.92 for the quarter, an increase of 31%, or 27% in constant currency. And I want to read this little breakdown in the comparable sales, where they say that quarterly comparable sales results were positive across all segments as we began to lap the significant impact of COVID-19 on our global results beginning in March 2020. Guest counts remained negative for all segments. So in the US, comparable sales results benefited from average check growth with double-digit positive comparable sales across all day parts. The company's strong national menu and marketing offers, as well as growth in delivery and digital platforms, contributed to the comparable sales growth. And then they talk about the international operated markets, which I think is super important to read. And they said that results reflected strong positive comparable sales in the UK, Australia, and Canada, partly offset by significantly negative comparable sales in France and Germany. Comparable sales in many markets continued to be impacted by varying levels of government-imposed COVID-19 restrictions on restaurant operations. So they point out that there are still, some government restrictions on restaurants across the world. And so likely they will see, some increases as those continue to be lifted in the coming months, hopefully. And then international developmental licensed markets monthly comparable sales results improved sequentially throughout the quarter. The strong quarterly comparable sales were primarily driven by China and Japan. So there is some other good information in here about, revenues and operating income, net income. If you want to look at that, I'll leave a link to this, report in the description. I think it's valuable to read, but we really just don't have time to go through it all. We're going to move on to some information about the dividends. So as you can see on Seeking Alpha, the current yield is right around 2.2%, which has an average payout or annual payout, of $5.16, which is pretty decent with a payout ratio of 60%, which I like to see. 5-year dividend growth rate right around 7.78%. And that is, something super solid, because I think that is sort of a number that can be sustained for a long time, but it's not. And it's, a fairly good number. It's not extraordinarily high where it can't be sustained, but it's not extraordinarily low where, it's not really much of an increase. And Seeking Alpha says dividend growth of 12 years, but I looked at multiple other sources and they all said 45 years. So they are getting closer to being a dividend king, which will be pretty exciting when that happens. And looking at the PE ratios, you can see, in 2008, 2009, the PE ratio was around 10, 11, 12. And it just has slowly been going up throughout the 2010s, through 2016 to, 2019, it was around 20, 22, 23. And then right now, the PE ratio for McDonald's is sitting all the way up at 34.07, which seems pretty high to me. I'm not going to lie, but you can see, that the stock price has continued to go up very steadily, and, increasing so recently. And the earnings as well have continued to go up very steadily, but no, nothing really crazy increases here. So that's the one thing that concerns me a little bit, is the stock price just keeps going up, a bit faster than the earnings. So I would like to, I think for me, see the PE ratio fall, or at least see them, grow earnings a lot more. Obviously, there's more factors to consider, but that's just one of them that I like to take a look at. And we can also look at, the PE ratio relative to the sector. So they're in the consumer discretionary sector or consumer cyclical, and they are in the restaurants industry within that right here. So as you can see, the average for the entire sector is 23.48. So McDonald's, and what were they at? 37, 34, 34.07. So McDonald's at 34.07 is well above that 23.48. And for the restaurants industry, it's 33.79. So they're pretty much right in line with the restaurants themselves, but compared to, the overall sector, they're definitely a bit overvalued. And looking at the stock price, past 8 months or so, you can see they're in this sort of channel here. If we put on these advanced lines, they're, kind of bouncing around recently in this little channel. So, obviously you want to see them fall to the bottom of that channel before you buy, at least technically. But I think that right now is really not the best time to be buying McDonald's. I honestly would like to see it, closer to the 200 range. If we move out a little bit further on the weekly time frame, you can see like 200 range. That looks pretty nice. And at that point, that PE ratio would be much lower. So for me, I think I'm looking around the 200 to 210 range to start buying for McDonald's. I don't think, that's the best price out there, but I think that is a decent price. That would be at least a decent starting point for a position. I think my brother's average cost is somewhere around there. So let me know what you guys think of McDonald's stock, and if you do own any. There's also, some complex things behind the scenes going on. They sort of have this business plan that, generally speaking, the trend would be for the revenues to decrease slightly or not increase as much, but as a result, it would increase their earnings and margins. So that's, something interesting to think about and decide for yourself. Do you think that's good for a business to be focusing more on revenues or more on income, and which one they should be focusing on increasing? So I hope you enjoyed this video. I'll leave a link right up here to another video I did on a consumer discretionary company, and that one is Leggett & Platt. I hope you do enjoy that one, and I will see you in the next one.